Let me take you through to introduction. We know that income from persons, most of us know that income from person, which is a personal income tax, it contributes the highest percentage of money that is collected by SARS. SARS as an institution have been given a mandate to collect the money from individual and have to the national treasury, and national treasury will distribute accordingly according to the needs of the state. So every employer, as we all know, every employer must withhold income tax from your salary and paid it over to SARS. So that's the money that is you are working and you're getting a salary. That salary you will get it net of its tax. So the amount that will be deducted there in the form of tax will be handed over to National Treasury by the South African Revenue Services. So in my slide there I showed, which I believe you also had, the contributors to the fiscus, the different contributors. There you also have in your module, because I took this from the module. I think this is from the tax period 2018 to 2019, 2018 or 2019. Remember, the fiscal period starts from 1 March to 28 February for individual, the following year. So in this slide there, you see that the personal income tax, which is recorded as PIT, contributes the significant amount that SARS is able to collect, followed by the value added tax, and thereafter it's fuel levy, customs, and others, which is normally we call it excise duties, customs and excise duties. And the least one is coming from CIT, which is income tax for companies. Okay, in the background there, what they say about SARS, they said in order for SARS to receive tax income from individual, certain processes has to take place during the year between the date at which the person starts working at the beginning of the year and the date at which their tax for the year is paid to SARS. A number of steps are taking place in this learning unit. We will discuss different steps that are allowed during what is referred as a tax year or year of assessment. Earning a salary. An employee earns a salary or wage for his service rendered to his employer. This amount may be paid weekly, fortnight, or monthly. Every time the employee receives a salary, they also receive a salary advice or a pay slip from the employer. The pay slip indicates the income the person earned and the deduction that were made from the person's salary for the week, fortnight, or a month. Deduction are amount that are deducted from an employee's gross salary or wage. The amount a person received after deduction is referred to as a net salary or net wage, depending if you are getting the money on the monthly basis or on a weekly basis. We can call it a salary or a wage. When your employer give you your amount, they will also give you a payslip. A payslip will show how did they arrived at the net amount that went to your bank account. So we call it a payslip. That document will show the gross income as well as the deductions. Different deduction will appear there. For example, if you are receiving housing allowances or you're receiving you also paying medical aid, those will deduction will be shown on your pay slip, as well as the amount that was withheld and paid over to SARS will appear on your pay slip. Okay, with regard to salaried persons as well as income, they are following deduction that are made from a person's salary. Like I already mentioned, that you'll find that in your pay slip, it will show all the deduction that were taken out from your gross income in order to arrive at net income. Excuse me. For example, income tax will be deducted. The amount that you paid to pension fund contributions, the amount that you paid to medical cost, they will be deducted. So let's look at the income tax as the major deduction that's mostly appear on the pay slip. The employer deducts the tax which an employee must pay from the employee's salary and pay the amount over to SARS at the end of each month. This system of deducting tax throughout the year is called as pay as you earn system. We call it pay at SARS. So the employer will deduct the tax and it will pay over to SARS at the end of the month. That amount is called as pay as you earn. Every year, the employer receives an employee's tax card from SARS. This guide indicates the amount of tax that must be deducted from a person's salary or wage. There are two sections in the guide. The one gives the tax that must be deducted from weekly wages, and the second section deals with the tax that will be deducted from the monthly salary you paid. So that's a tax card you receive from the South African Revenue Services. So this normally happen at every year. If there are changes to the previous tax card, the employer will receive a new employee's tax card with the new rates applicable to that particular year of assessment. The pension fund contribution as well as provident fund contribution. Okay, so with regard to this one, it's a relate to the pension fund contribution as well as the provident fund contribution. This way they are work very similar, but with regard to deduction, they slightly different there. So most of our employees, for example, where I work, we belong to an employer's pension fund, which is administered by a certain institution. So every month when we got our pay slip, certain percentage of that amount is being paid to that particular pension fund. So, okay. What they said here, most permanent employees of the company belong to the employees pension fund or provident fund if employer has one. Normally, most of employers, especially with the public sector, have a provident or a pension fund where they take some few monies and they from the employees and they paid it over to that pension fund. The monthly contribution required to be paid to the fund are normally based on a percentage of a person's gross income. Exactly. So the amount that we pay today is based on the percentage of our gross salary. That means if you are earning certain amount, you will contribute, for example, 5% to the fund. Someone else who's maybe higher, so it will be different based on different scales of pay. So that's how it works. Sometimes the employer, which is normally happen to the public sector services, will make an exemption to the public sector services because that is where I am based and where I understand it, how it work. So the employer will also contribute a certain amount. For example, let's say I'm contributing 2,000, the employer will also contribute 2.5 of the year amount. This is a benefit that I am getting from my employer. I contribute, they also contribute certain amount there. So down there they explain that the pension fund required members to annuitize most of their balance while a provident fund allow full cash withdrawal. So in terms of the pension fund, you can get an annuity amount. Annuity amount it's related to the amount that you normally get on a monthly basis. That is an annuity. While the provident fund it's allowed a full cash withdrawal. So this gonna be a once-off amount that will be
Sorry.
allocated. Okay, let's move on to unemployment insurance fund contributions. They say all employees and employers are expected to pay an employment insurance fund, which is normally known as UIF. Normally, we will contribute 1% of our salaries to this amount. The aim of the UIF is very simple, is to provide you with some income for a couple of months to enable to find a new job. If you are not working, you can able to or let me say, if you just lost your job, you are able to go and claim the UIF, the amount that you were previously contributing, and for just to enable you to survive after you have been retrenched or whatever the reason until you find your new job. The fund it also provide maternity income for women who are not able to work for a while because and after, before and after the birth of their baby. So if you are in that situation, you may qualify for a UIF. Okay, the employer pays the amount over to SARS or the UIF commissioner depending on the employer's tax status. The employee and employee both pay 1% of the employee's gross income up to a maximum amount announced from time to time. Exactly. The amount is always be 1% of our gross salary. We also had medical aid scheme. For example, I belong to a certain medical scheme which is Bonitas, others they are undiscovered, and there are so many medical aid scheme companies that exist in this country. So even on that one, I contribute certain amount to the medical so that I am able to get assistance from them to cover my medical bill when that situation arises. And also the employer, my employer is also contributing something there. So let's see here what they say about the medical aid scheme contribution. The medical aid scheme contribution amount which an employee belonging to a medical aid fund pays toward his medical cover. If an employee belongs to a medical aid scheme, the medical aid scheme will pay certain medical costs on behalf of a member. A person medical aid fund contribution is a fixed amount that is determined by whether the employee belongs to the fund as a single member or whether or he or she has a dependent or dependents belonging to the fund as well. Usually, an employee may decide whether she or wants to belong to a medical aid fund, some employers subsidize a portion of an employee's total medical aid fund contribution. As I have already alluded, that you might find that you are paying to a certain medical aid scheme as well as the employer is contributing towards that medical cost just to relieve the burden on you. So it depends. If you are alone, obviously you will. If you're the only one who belong to that medical scheme, you will pay certain amount. But if you and your family members or your dependent rather, you will also pay the extra amount. That's how medical cost works. The membership fees, normally we belong to various membership organization bodies, and for example, unions, maybe another associations in the organizations, and we also contribute that. But most familiar or of this medical of this I mean membership fees, it's the union, it's the trade union. So you might belong to a certain trade union. The trade union will assist you or act on your behalf if you have some issues with your employer, and they will represent you there, and you have to pay them certain amount. So this amount we call it membership fees. You pay that amount, it will be shown on your salary on your pay slip. And normally, how much is it? It's a very small amount, just less than 100 rand in our organization. We call it a membership fee. It's the amount that we pay to our trade union, which we belong to. They will assist us in terms of salary negotiations and so forth. Or when we have some issues within the organization, they will represent us. So we paying them certain amount. Okay, and move on to slide number 6. Other sources income. Individual can also earn other income, for example, rental income, interest or dividend. Tax will also be payable on this income after applying certain exemption. But neither this income nor the applicable tax will be reflected on the payslip as it is from another source. That's correct. This amount is from other source, it's not from your employment. So this amount will also be taxed. You'll find out some regular questions when it's that time of the year when we have to submit our our return to SARS. People will ask why I'm supposed to submit this thing because SARS is I'm paying the tax on a monthly basis. Why now I have to submit this? Okay, one of the reasons is because you are earning some of this income, and this income is not there on the payslip because this coming from other sources which is outside your normal work employment. So you will not find them on the payslip. So when you are submitting the return, you will also include this income. Then that's mostly the main important point when someone is asking why I have to submit a return while my employer deducts my tax on a monthly basis. So you must always remember that other incomes coming from other sources, you must also include them in your return and they will be taxed accordingly after applying certain exemption. IRP5 certificate. At the end of each year of assessment, which is normally the 28th or 29th February each year, or we call it the assessment year, or the tax year, the employer must provide the employees with an IRP 5 ITA3A certificate. This certificate contains information about the employee's income and the expenses deducted from their salaries. This certificate is a summary of the most important information on a person payslip. This certificate is one of the major sources document when completing a tax return. That's correct. When it's that time of the year, normally in July, we are busy completing our tax return. We need to obtain IRP 5 stroke IT 3A from our employer. You go to your employer's HR, which is human resource, and you request this document. Once you have this document, you will be able to complete a tax return and you take that tax return. You can do it via online. We have something called e-filing now, or you can take the documents and other supporting document, you attach them, you go to your nearest SARS branch and they will do these things for you. Any questions so far? Okay, I don't see any question. Let me continue. So the taxpayer uses this certificate as well as other information on other revenue, and as we already said earlier, that you have to include other revenue which is coming from other sources to complete your income tax return. All this information is used by SARS to calculate the taxpayer's taxable income. The tax payable based on the taxable income is then determined. If the employee's tax deducted during the year is not sufficient, the taxpayer must pay the outstanding amount. So when you are done with completing your tax return, the SARS will submit it to SARS via different channels that are available to you. Then SARS will calculate the amount whether you owe them or you have paid them extra. That's why you'll find some other people getting a refund, some other people have to pay SARS. It's the reason of this. You will do this at the end of the financial year and then you get your RRP5. You will use this document to complete your tax return. Don't forget to include other income from other sources. Then SARS will determine whether you owe them or they owe you. If they owe you and they have processed your information, normally you will get an SMS, and within 3 days the amount will reflect in your bank account. Let me continue to the next slide. Person liable for income tax. Taxpayer, depending on their age, do not pay up to a certain amount. I like this. These taxpayers are these amount are calculated every year on the current year's tax rates and rebates. We refer to this amount as the tax threshold for the different age categories. Underneath there, you see that you are required to pay income tax if you earn more than 95,750 and you are younger than 65 years. 148 to 117 and you are younger than 65 years or older but younger than 75 years old. 165, 689 and we are younger than 75 and you are 75 and older. So that means depending on the age, you will only tax from certain amount. That's what this means. That's how I have presented there. So I'm on slide number 8. Let me check. Yeah, slide number 8 now. Yeah, that is where I'm at currently. So tax threshold applicable to individual. This was for the 2023-2024 year of assessment. And I'm sure it hasn't changed. Remember, every year when the Minister of Finance is table the budgets, he will give us the new amounts. This one haven't changed, and I'm sure it's still like this. So if let's say you can see the taxable income, person under the age of 65, persons 65 years and older, and person 75 years and older. If your taxable income it's 95,750 and we are under the age of 65, the annual rebates, the taxable income, then the rebate that you will receive will be 17 to 35. If you are 65 years and older, and the taxable income threshold will be, but you will understand most this when we are providing you, excuse me, you will understand most this when we are doing the tax table. You will more familiar and you will also understand it's clear when we are normally do the examples. So this is how it works. So for older person, they get a higher annual rebate. As you can see from 75 years and older, you will get 29, almost 30,000 rebates. 65 years and older, but not over 75, you will get 26,679. The less and less you are of your age, then it's depend on the age, and then you will able to receive your amount. But the most beneficial, as you're getting older and older, you will receive more and more rebate. But you will see this when we are normally doing our our examples. On slide number 9, they are saying a rebate cannot create a refund to the taxpayer. This means that if the tax calculated is a negative amount after deducting the rebates, the tax calculated must be limited to zero. A taxpayer can only get a refund if too much tax was paid throughout the year. So a rebate, what they're saying there, a rebate cannot create a refund to the taxpayer. Let's go back to slide number 8. So if you are 65 years and under, let's say you are 60 years and your taxable income, it's, for example, is 10,000. If you take 10,000 minus a primary rebate of 17,235, the amount will be minus 7,235. That is not allowed. That is not allowed because a rebate cannot create a refund. So the amount will be limited to the taxable amount of 10,000. The, the, so it won't create a negative amount. That's what they mean. The only time when a taxpayer is getting a refund It's when you are completing your tax return and when SARS do their calculation, they find that during the year you have paid more, then SARS would refund you based on that. Any question? Registration as a taxpayer with SARS. So it's good now. There are so many ways you can do this. You in our days we are no longer go and have those long queues at SARS. We just go to their websites and do things, or we just communicate with a professional. It could be a lawyer or an accountant, and they will do these things for us. A person who earns an income, salary, or wage that is above the threshold as discussed about from employment has to register as a taxpayer for income tax purposes. The Act also makes provision for persons who earns other income to register for tax in certain circumstances. A South African resident can also register for personal income tax by registering for SARS e-filing for the first time. SARS will automatically register the person and issue a tax reference number. An employee can get registered through their employer via SARS e-filing. A person can also register at a SARS branch. Like I said, that's when you are earning an income and it's above tax threshold, you are required to register as a taxpayer for income tax purposes. In certain circumstances, when you are earning other income, you will also need to register. You can do this yourself. You can register via e-filing. You do your things and then you follow the step there. Then SARS will automatically register you. Your employer can also register you when you are joining an employer and an employer determines that the amount is above the threshold, then the employer can automatically register you via e-filing, and then you will able to get a tax reference number, which we normally say it's a tax number. You can also take all the necessary document, your ID, your proof of address, and so forth, all those documents that are required, and you go to your nearest SARS branch and they will register you. Okay, while I'm still on here, so so it's very important that you don't touch this one when you have been employed and then you see that the amount is above the threshold, then you must automatically go to register. You can do that yourself. You can also ask a professional people to help you do it, or you can also ask your employer to do you it for you immediately. You can also visit SARS branch. Let's continue. We were on slide number 10 where we were emphasizing the need to go and register when your income exceeding the certain amount, which is forcing you to go and register with the fiscus, South African Revenue Services. But sometimes you are excluded to submit a return based on a certain requirements. I remember that it's if you are not earning in your annual income is 500,000 and less, then you will be excluded provided that you meet certain requirements. Okay, let's not waste our time on that. Let's go to slide number 11. Exception to the general rule of compulsory submitting the submission of a tax return. When are you not forced to submit a tax return? An individual is not required to submit an income tax return if their gross income consisted solely of the following. Remember, we spoke about the submission of the tax return where you need to go to your HR and you request your IRP5. From that IRP5, you will able to complete your tax return and you submit it to SARS. You can visit their branch and submit it there, or you can do via SARS e-filing. So here, these are circumstances where you do not need to submit that tax return. So, number one, they said an individual is not required to submit an income tax return if their gross income consists solely of the following: the total employment income or salary for the year before tax or gross income was not more than 500,000. So, if your gross income was not more than 500,000, and remember, and you only receive employment income or salary for a full year of assessment from one employer, and you have no car allowance or company car or travel allowance or other income, interest or rental income, and you are not claiming tax related deductions or rebates, e.g., you are not claiming medical expenses, you are not contributing to retirement annuities other than pension contribution made by your employer. Employees' tax has been deducted or withheld by your employer. Interest income from a source in the Republic not exceeding 23,800 in the case of an individual below the age of 65 years, 34,500 in the case of an individual age or above the age of 65 years, 23,800 in the case of an estate of a deceased person. Dividends and the individual were a non-resident for the 2024 year of assessment, amount received or accrued from a tax-free investment. So they said here, you are not required to submit a tax return, but you must meet the following which they have listed there. You must not earn an employment income or your income that is above 500,000 and you were only receiving a salary for the full year from one employer. If you are receiving a salary from two employers or more, then that means you are prohibited. If you're receiving a car allowance or a company car or even a travel allowance, or you are earning other passive income, for example, interest income or rental income, then you will not able to use that benefit of not submitting an income return. So student, is very, very important to know this requirement when you are not compulsory to submit an income tax return. So it's very, very important that you know this one, the exception to this rule. Because most of the student, they just thought, if I'm not, if an employee is not earning more than 500,000, then it automatically qualifies. That's not the case. There are certain requirements that you need to satisfy before you can qualify. They have been listed there. Okay, we are moving to, okay, we are still more on the same slide. You should have noted that the threshold of 500,000 refers to individual taxpayers who are no longer required to file a tax return. It does not mean taxpayers who earn less than 500. It does not mean taxpayers who earn less than 500 a year will no longer pay income tax. I'm sure you understand that. You can still pay income tax when you are earning less than 500,000 if you don't meet all those other additional requirements. They said that the filing threshold is not the same as the tax threshold, but you will also see that one when we finally discussing the tax tables. The tax threshold refers to the amount when a taxpayer doesn't have to pay tax or to have pay deduction. That's a tax threshold, not the filing threshold. When are individuals required to submit an income tax return? Now, you have to submit a tax return because you did not qualify or you were not on the list of excluded person who need not to submit tax return. Then when are you required to submit that tax return? Where a taxpayer conducted any trade in South Africa, or if a South African tax resident conducted any trade. When a taxpayer receives an allowance such as travel subsistence or office burial allowance, if a taxpayer holds any fund in a foreign currency or assets outside of South Africa that have combined total value of more than 225 at any stage during the year of assessment, where a taxpayer has realized a capital gain or capital losses exceeding 40,000 in the year of assessment, if any income or capital gain from funds in a foreign currency or asset outside the public was attributed to a taxpayer, where a taxpayer holds any rights in a controlled foreign companies. So these are the requirements. This is when are individual required to submit a return. So you will require to submit a tax return when or you meet all these what have been listed here. So we will still gonna cover the capital gain and losses. You will understand this 40,000 threshold, which normally is an amount that is granted to you as a benefit. You will also know the CFC, which is a controlled foreign company, we gonna also cover it here. But this is when you are required to to submit a tax return. When we are conducting a trade in South Africa and you are a resident, you are conducting the trade here in South Africa, you must submit a tax return. If you are also receiving an allowance such as a travel allowance, a subsistence, or office bearer allowances, which is normal, we call it a fringe benefits, we're still gonna cover here in this module and you will understand better. Then you will have to submit a tax return because those travel and subsistence allowance that you are given are taxed under Schedule 8 fringe benefits. If you hold any fund in a foreign currency or outside South Africa, that has a total value or a combined value of more than 250, 225,000 during the year of assessment, you are required to submit a tax return. If you have dispose an asset and you make a capital gain and that capital gain exceeded 40,000, then you will need to submit a tax return. If you are earning any income from a foreign current asset, which because you have some certain control there, maybe 10% or more, then you will be able to submit the income tax return. Okay, there down there they explain the term trade. They said it means every profession, trade, business employment, calling, occupation, venture, including the letting of any property. That's what the trade means. So if you are a professional, you are providing a service, that means you are conducting a trade and you need to submit an income tax return. Let's move to another slide. They talk about the income tax return there on slide number 13. I know that most of the items, most of the terms that we have passed here, you haven't find them anywhere. But this is just an introduction. When we are doing calculations, and then this will become more and more clear, and you will understand these terms which we already covered in the previous slide. Don't panic, don't panic. Text is not difficult. It's very, very simple. It just need you to do a lot of questions and practical questions and answers. It's not difficult like other modules. It's the module which I did enjoy it very much while I was still a student because everything that is there, you find it sometimes it's more practical, especially those who are already working. They know what is a pay slip. They know the deductions there that appeared on their pay slip. So it's a very, very enjoyable module. So you mustn't panic. You mustn't panic at all. You will do wonders in this module. Then we are now covering income tax return. Taxpayers are required to submit an income tax return annually. I think it's around July when they call it SARS. It's a tax season where they will have a lot of visitors there at the branch. Others would submit their tax return via e-filing, and then SARS would determine whether there is a refund or you need to pay SARS. ITR 12 income tax return 12 forms, which we normally say it's income tax for individual. These forms is called ITR 12 forms income tax for individuals. That's how we normally call it. ITR 14 forms it for company tax, but that is out of our scope. We will be focusing on the ITR 12, which is income tax for individual. ITR 12 forms annual income tax return are pre-populated by SARS, which means that all the taxpayer information from the IRP 5 or ITA 3A stroke ITA stroke already appears on the return when it is downloaded or received from SARS. So when you are going to the SARS e-filing, you go there, you log in there, you go to this form, it's there, you go to this form, you download it, the information is already there. The information is already there. What you just need is just to confirm or that the information that is appeared there, it is correct, or you need to do some additions, or you want to make some adjustment. But the information, it's already there. It's not like you are starting from scratch when you are doing this document. Each taxpayer needs to answer a set of questions relating to income received, deductions made, etc., and then a unique return is compiled depending on the answers to the question. Most of the questions there, it's a yes or no, yes or no. Did you receive in other income for this? Yeah, no. Did you receive dividend? Are you a member of a corporation or a CC? Yes or no. So those are normally the sets of questions that appeared when you are completing your ITR 12 forms. The taxpayer is required to confirm all the information on the ITR 12 before submitting the return to SARS. The taxpayer can edit the return to ensure that it reflects the correct tax position of the taxpayer for that specific year of assessment. As I already mentioned, that the information is there, you have to confirm if the information that is there is correct, and if there is some addition or you want to make some adjustment, the form will allow you to edit the return and you make those necessary adjustments before you can submit the return. So once you have completed the return and everything, you are happy with the information that is populated on the return, and you are able to answer all the questions, then you will be able to submit the return. They will ask you some questions. Are you sure you want to submit? And you would say you click the button submit, and it will show before the return goes, you will have to calculate the amount. It will give you an option to calculate the amount. Then you do the calculation. It will show whether the amount you have a refund. The amount will show as negative minus 10,000 if your refund is 10,000, or the amount will be 10,000 with no negative sign, which means you are owing SARS an amount of 10,000. Then you will submit. Immediately when you are submitting a return, you will receive a message. it's gonna be SMS if you're opted, or via an email if you're not opted that way. And after that, your refund will be paid within normally not more than 3 days after you have submitted your return. But if you owe the amount, I think you have 30 days or the calendar days to pay the outstanding amount. Failure to do that can result to penalties and interest. Any question on that one? The income tax return. How to request and submit a return. You can request a return through any of the following channels described below. E-filing, e-filing, we know e-filing, most of us know e-filing. It's the quickest and easiest way to obtain a return. The quickest and easiest way to obtain a return is to register as an e-filer on the www.sarsefiling.co.za and to request and submit the completed return online. So when you qualify to submit a return, you can register. You go to SARS e-filing, www.sarsifiling.co.za, then you will able to register as an e-filer. Once you completed and it has been confirmed that you are an e-filer, then you will able to go to your e-filing and you are able to submit your return online. Another method is SARS Mobi app. I heard that there is something called SARS Mobi app. I never use it. I'm an e-filer, so I submit my return via e-filing. Mobi app. If a taxpayer has a smartphone, unfortunately, I don't have a smartphone, so that's why I do not qualify as a SARS Mobi help uh, submitter. If the taxpayer has a smartphone, the taxpayer can install the SARS e-filing app from the App Store for Apple devices or Google Play Stores for Android devices. Once installed, the taxpayer can log in with their e-filing profile. So they said if you have a smartphone, you can install SARS e-filing app from the App Store or Google Play and you install it, then you are able to log your e-filing profile, then you are able to submit a return. Another way is SARS branch, which is normally an old method, but a lot of people are still doing it. I've seen a lot of um employees still going to SARS with a lot of documents and they said we are here to submit our return. SARS branch, the taxpayer also has the option to visit any SARS branch and a SARS official will assist the taxpayer in the completion and submitting the income tax return. So when you are visiting the branch, you can make a booking, then they will be waiting for you. You bring all the documentation, your payslip, your IRP5, it's the most important document. Then you go to the branch. But when you are making a booking, they will tell you which documents you need to submit, you need to bring along when you are submitting a tax return, and then an official there will assist you in completing the return. The SARS Contact Center. A taxpayer can call the SARS Contact Center on 0800 0072 77, and the SARS Contact Center agent will assist the taxpayer to customize the income tax return and send it via the postal savings. Once the income tax return is received, the taxpayer can complete it in full and post it back to SARS. So you can also call them, and then the contact center agent will assist you with your income tax return. But when you are calling them, you must be patient. On these days, SARS, when you are calling them, you can also request a call back. Then they will call you back. Then they will assist you. The tax practitioner. A taxpayer has the option to utilize the services of a tax practitioner. The tax practitioner will complete and submit the income tax return on behalf of the taxpayer. They said the SARS preferred method for completion and submission of income tax return is electronical through e-filing. So with the tax practitioner, they mean that the accountant, the lawyers, those are professional service providers. They can help you and do the tax return on your behalf. They will normally charge you for that services. You also have an option to use them. But the preferred method that SARS recommend it's via e-filing, which is the normally the quickest way of submitting your tax return. Okay, down there they said SARS will request supporting documentation when the return is submission, as I already alluded on that one. You can refer to the tutorial letter for the list of documents SARS will request you to bring along when you are going to do your tax return, for example, from a branch. Documentation required to complete an income tax return. Taxpayers need to use supporting documents to complete an income tax return. Below are examples of documentation that may be required to complete an income tax return. It's IRP 5/IT3A Employees Tax Certificate for remuneration received or in respect of lump sum from your employer pension fund, provident fund, or retirement annuity fund. Certificates received for local interest income, foreign interest income, or foreign dividends income. If the taxpayer is married in a community of property, the certificates received by both the taxpayer and the taxpayer's spouse are required. If the taxpayer is married out of community of property, only the certificates that the taxpayer received are required. So these are some of the documentation that you need in order for you to be able to complete the tax return. Normally your IRP5, it's impossible to complete a tax return without IRP5, which is called an employee's tax certificate. When you have investment and you are earning interest income, or you in the or dividends, it's depend whatever, usually you will receive some certificates from the company where they call it a tax certificate. Then you're gonna use that certificate in order to complete your income tax return. If you are married in a community of properties, the certificates received by both of you will be can be also used to complete a tax return. So with regard to local income, interest income, foreign interest income, and foreign dividends income, but you will understand this when you are doing those questions, because here it depends how you the tax implications on this. We call it passive income. It depends whether you are married in or out of community of property. Hence, you see that the certificates are received for local interest income, foreign interest income, and foreign dividends. Then underneath there, you'll see that they mention when it's married in community of properties or whether it's married. So there's a different requirement there. So, but you will mostly understand how this work when we normally do the examples in the other slides. Documents relating to medical expenditure such as the tax certificates received from the medical scheme for the year of assessment if the taxpayer belongs to a medical scheme, proof of qualifying medical expenses paid by the taxpayer and not recovered from a medical aid scheme. So when you are belonging to a medical aid scheme, then you can use, they will normally issue a tax certificate, and that tax certificate you can also use to complete your return. They also a proof of qualifying. Remember that they sometimes you go and you pay, but the amount that you are paying to a practitioner is not covered by your medical aid, and it's coming from your own pocket. You need to keep proof of that, because when you claim that, you will also require to provide proof. So you must keep those uh, those invoices when you gonna use them when you are completing a return. Completed ITR, the confirmation of diagnosis of disability form if the taxpayer wants to claim disability related expenses. So you will also need this document only if you want to claim the disability related expenses. So it's very important when you are completing your tax return, you wherever you claim something and you have proof of documents, it's good to just attach that. But even if you did not attach, in some instances, SARS official will call you and request those documents. But it's good if you have attached them, because they will just look at those information and they will quickly process your information. Okay, we are moving. I'm on slide number 17 now. The income tax certificates from the financial institution for retirement annuity contribution made. So you will also need these documents when you are claiming retirement annuity contribution. So the institution in which where these retirement annuities are made to will normally give you an income tax certificate. Others they just call it tax certificate, but it is an income tax certificate. There is also a section 18A donations tax certificate. If you are claiming a donation, you cannot just claim the donation, but you need a certificate, then you will only able to claim a donation that is made to a qualifying institution. Then you will be able to claim a donation and you must keep this certificate. All information relating to capital gain transaction, local and foreign, for each proof of proceed for each asset disposed, such as sales agreement invoices, ITC certificates, calculation of the base cost in respect of each asset. So you will also need to provide the fiscal proof of capital gains transaction. If you have sold your house and you are completing your return, and in your house, which was your primary residence, and you made a profit there, you will need to provide SARS the amount of your proceed. For example, it's a sales agreement or sales invoice which show how much was the assets sold for and the method of how did you arrive at the base cost. Remember, you will have a capital gain, you're gonna have a profit minus base cost, and then you will able to calculate a capital gain, but you need a proof of how did you arrive on that capital gain or capital loss. So SARS will need those information. Documents and receipts for commission related expenditure including logbooks to claim business travel deductions. Sometimes you are given what they call it, we call it a French benefits. You are required to travel and the company is giving you a motor car and then you using that car to go place of work and you go home and then SARS will determine which amount were business related, which amount were private related. So you need to have that logbook which you would say for this travel that I have claimed it was for business and this was for private and SARS will tax you on the private kilometers travel. But you will also see this and understand it's clear when we are doing calculation for fringe benefits. For now, just know that you will need to have a logbook when you are receiving a commission or you are using a motor car or whatever the ex- the benefit it is. All information relating to the letting of assets, e.g., rental or lease agreement, bond statement reflecting interest on bond if claimed on a return, schedule of details, rental expenses, related invoices. So when you are letting some of the assets and you are receiving income, or you are paying some and you want to claim those expenses, you will also need some supporting invoices in the form of lease agreement or or invoices which you are receiving from the person who is letting you an asset. Financial statement for trading and farming activities, if applicable, if you want to claim or you're providing profits on certain profits while you are completing for a portion from the partnership, you get your portion, then you also need to provide this financial statement. And you also need any other document relating to income that must be declared or deducted, that may be claim, or the deduction that may be claim. In overall, what they normally saying here, whenever you want to claim something or you want to add something, or rather, whenever you are completing a tax return, you must provide supporting documentation. If you are claiming something, you must provide proof that that claim is legit, that expense did occur or did takes place. If you are receiving something, SARS wants you to provide proof that, in fact, I received 10,000. The certificate would say, no, this interest was indeed 10,000, because we don't want to find a situation where you receive 10,000, but you are only declaring 5,000, and SARS will deal with you accordingly if you are understating your income. So whenever you're completing a tax return, please ensure that you attach or you have all the information as supporting documentation in order to support the income or deductions that you want to include in your tax return. It's very, very important. I move on to slide number 18 now. Income tax assessment. I can see there's a skeleton there. The information the taxpayer provide in his or her income tax return is used by SARS to calculate the taxpayer's final tax liability. The result of the assessment process by SARS is the issue of ITA 34 income tax assessment. When you are done with completing your return, you send it to SARS, then SARS would process your income tax return, and they will calculate your final tax liability. The results of the assessment process by SARS would issue a letter. They call it ITA 34. It's income tax assessment. So you will see your normal, all the information that you have submitted to SARS, your annual gross income, your deductions, everything there, your donations or your contribution to retirement annuity or provident fund, and at the end of the day, you will see your liability. The form is called ITA 34. It will populate all your information there. To assess a taxpayer, SARS follow the following process. It's a gross income, which is a gross income and income before any deduction, less income or non-taxable income. They are income that is non-taxable. For example, others they call it exempt income. Those are non-taxable income, exempt income. For example, the one I can remember, it's local dividends. If you are receiving local dividends, you are exempt provided certain requirements have been made. Less allowable deductions. So there is allowable deduction, for example, the deduction that's your contribution to medical aid, to retirement annuity fund, and so forth. At the end of the day, you're gonna have taxable income. Taxable income. This taxable income will be used to calculate your normal tax. So after you have determined the taxable income, SARS will calculate the tax liability based on tax table. You will see the tax tables, but income tax, the tax liability, you will have income tax, and then the tax liability will be calculated based on the tax table. If you are earning a lot, that means you pay more tax. If you are earning lower than someone else, you will also pay a lower tax than that somebody. You're gonna, after the SARS have calculated the tax liability, they will minus annual rebates. They will minus annual rebates. If you can recall earlier in one of our tables there, we have people who are 65 and over, 65 and under, there's certain amount rebates. 65 and below 75, there's a certain amount applicable to them, and 75 above, there's a certain amount. Depending on the age of the taxpayer, they will determine which category of the annual rebate he falls in, and then they will apply accordingly. There will be a normal tax payable or refundable. This is how SARS determine your income, your normal tax payable or refundable. The taxpayer receive an ITA 34 showing the completed tax calculations and whether a taxpayer is a tax liability or tax refundable from SARS. The ITA 34 will show the date the ITA 34 was issue date, the due date if the taxpayer need to pay SARS. I think it's 30 or 31 days or 25th of the s- coming month of the following month, and the final date on which the final payment need to be made to SARS. The ITA 34 will also show whether a taxpayer is a provisional taxpayer and whether the taxpayer has been selected for audit verification. So that's the information that will appear on the ITA 34. So when you go there or you receive this information will tell you, okay, this is how they calculated the amount that you owing or the amount that they owe you. They will show gross amount, deductions, your contributions, and then they will arrive at the amount. They would say the amount refunded to you is so and so, or the amount that is payable. Underneath there, they will show you that this ITA 34 was issued or was downloaded on this date, and the due date or when you are needing to, when you are required to pay the amount that you owe to them. For example, they will tell you the 25th of the following month, excluding the public holidays on Sunday and so forth. But that's all those information is there on your ITA 34. They will also tell you when you have been selected for audit verification. So they will also, that information will be there on your ITA 34, and the auditor will be assigned a case, and they will start requesting some information from you. If they are happy with the information provided, then they will close the case, and then you will receive your amount if there is a refund, and you will able to pay the amount. But when the case is under audit verification, it's very important that you cooperate with an auditor so that they can fast track the audit, and you are able to finalize the case whether you receive your money and your payment. You won't receive anything while the case is still under audit. It is only when the audit has been finalized where you can get your refund. I'm moving on to number 19. I'm moving on to number 19 slide. A taxpayer should revoke the ITA 34 when issued if a taxpayer is in agreement with the tax calculation as shown on the ITA 34. The taxpayer don't have to do anything. That's correct. If you are in agreement, then that is a final final tax calculation, and you accept it. If there is a refund, then you will receive your refund. If you have to pay, you will need to pay according. In the case of a tax liability, the taxpayer will have to pay the tax payable as shown on the ITA 35 by the due date. They will tell you when are you required to pay the amount, or you will have to wait for a refund in the case where SARS said so, a refund the taxpayer. When when SARS is owing you, and you are in agreement with the information on the ITA 38, 34, you don't have to do anything, then SARS will refund you. Normally, it takes only 3 days to refund a taxpayer after you have received your ITA 34. You will receive an SMS. They will tell you that you will receive your refund, and your refund will be paid to you. If a taxpayer does not agree with the calculation on the ITA 34, the taxpayer can follow the following step: a request for correction if information on the income tax return was completed incorrectly. A request search for reason. You submit a notice of objection. Colleagues, we started at 6:15. I think Mr. Craig would allow me to proceed until 8:15, if possible. Okay. So if you are not in agreement with the outcome of your ITA 34, you can follow, you can request for correction if the information on the return was completed incorrect. Then you can go there on the e-filing, and you when you are requesting for correction, they will reopen and will allow you to do the corrections. Another method, when you are not happy with the outcome, you can request us to provide a reason for the information that has been populated on the ITA 34. You will request the reasons. They will provide you reason why the outcome was that. So after that, if you are still happy or you are not happy, then you can also submit a notice of objection. So that means you are object to the information that has been provided to you by the fiscus. Normally, you will write a letter of objection. You provide the reasons why you are against with the information that has been provided to you, and you can also provide some supporting documents in order to support your objection. Then after SARS receive your objection and the information, then they will study your case, and after that they will provide an outcome. An outcome can be in your favor or can be at SARS favor. But if you're still not happy with the outcome of the notice of objection, there are other channels that you can also follow. I hope you all understand and agree with me. Okay, here we have a framework for tax calculations. This is a framework for tax calculation. This is a framework and it must be followed like this. So that's one important point which is very crucial. Whenever you are doing tax calculation, you must know the skeleton, you must know the framework like this, what comes first, what comes next, and so forth is very important because some of the information that is needed here you have to calculate from the result of the previous calculation. So when you are not able to follow the framework, your calculations might be incorrect and you will lose a lot of marks of which you could have easily got. So the first one is taxable income. We have shown you how we arrive at the taxable income. Taxable income, it's a gross income less deductions. Let me go to slide number 18 again. This is how we calculate a taxable income. It's a gross income less income or non-taxable income, which is exempt income, income that are not taxable. Then you have allowable deductions, then the outcome there will be taxable income. Let me go back to slide number 20. It's taxable income, then you calculate in normal tax. Normal tax according to the tax table. Remember, we are using a progressive tax system in South Africa. The more you earn, the more tax will be charged on you. The less you earn, the less tax you will be charged on you. So you're gonna use a tax table. You have able to arrive at taxable income. Now you have to provide a normal tax according to taxable. So the normal tax, okay, let's say you calculated your normal tax according to taxable and you arrive at 10,000 for example, you now have to minus a rebate. A rebate, remember rebate is based on the the age, it's depending on the age group or age categories you falls in. There is a primary rebate which is normally for people who are less than certain age. Okay, I can't remember the age, but those any age below 65, it's a primary rebate. But 65 and below 75, we call it a secondary rebate. And above 75, we call it the final or tertiary rebate. After that, you're gonna have a medical scheme fees, which is a section 6A. You will see when we are doing the medical fees tax credits. You will understand this one better. So medical aid, you will also minus it. You have your normal tax, you minus rebates. Rebates is the first deductible items under normal tax. We have a primary rebate, secondary rebate, and tertiary rebate. We also have to deduct your medical scheme fees. It will depend whether it's you or you also have other dependents. The more and more dependents you have, the more you will qualify for tax credit. We also have additional qualifying medical expenses, which falls under section 6B. You would see that when you are doing medical fees schemes. You After that you will deduct foreign tax which qualified under section 6 code rebates. You will also understand it when you are doing foreign tax. For example, when you have been taxed abroad and South Africa and that company they have that agreement which is normally they call it DTA, double tax agreement. Then you already paid the tax abroad, then you will qualify some tax relief when you are completing your tax return. We will after that we will arrive at a normal tax payable, and we're gonna have less prepaid tax. The tax that we already paid, we have to minus it or take it out from our normal tax payable. Then we will arrive at the employees tax. We also have provisional tax. There are taxpayers who are being called provisional taxpayers. So we still gonna cover that, and you will understand them when we are actually doing that one. And after that, we will arrive at the tax liability. This will be the final tax liability that you will need to pay over to SARS. But student, the most important things is that you must understand the definitions, you must understand the sequence when you are calculating the tax liability. The sequence, you determine the taxable income after gross income, less exempt income or non-taxable income. You also allowable deductions, but we all still gonna cover that. You will arrive at the taxable income. You will use a tax tables in order to able to calculate normal tax. After normal tax, you have determined according to tax table, you will able to deduct rebates. There are three different types of rebates. It's based on the age group. There is a primary rebate, there is a secondary rebate, and there is also a third rebate for employees or for people who are over 75 and above. Who are 75 and above. There is also a medical scheme fees that you need to take out. So SARS will give you some tax relief on the medical fees that you are paying to the medical aid bodies. we also cover that you will understand it best. We also have foreign tax. If you invested in a foreign country and then you have paid the tax there, you might qualify for 6 court rebates if the government of South Africa and the government of foreign country they have an agreement in place. After that, you will arrive at a normal tax payable. You will minus the prepaid tax, the tax that you already paid, and then you will arrive at the tax liability. Let me pause here and then we will next Monday we will start the tax tables from the tax tables then until we finalize this this slide or this topic rather, salaried person and income tax. So I'm waiting for questions. If no question, then I will pause here and I will like to thank you for participation and for attending. I really appreciate it. And I hope that you enjoy this session, but you will enjoy more when we normally do the examples because that is where things will be much clearer. Mr. Craig, I'm handing over to you. Thank you so much, student.
Thank you, Mr. Shoji. Thank you, students.